Welcome back to the deliberations of CNBC TV18 Citizens Monetary Policy. I've been speaking with Chairman of our committee, Dr. Pronab Sen, and members Kanti, Ghosh, Samiran Chakraborty, Sajid Chinoy, and Sonal Verma. Gentlemen and Sonal, thank you for your patience. Sajid, let me come to the stance. Even domestically speaking, domestic impulses, the Reserve Bank has always said that it will be more domestically moved. Here, if you look at the way in which inflation numbers have trended, would you get food inflation, for all that you say, has been coming down from the peak? So do you think that there is a chance of a stance change?
I think the time has come to change stance to neutral, because I think the main reason for not doing that was to get a better grip on food inflation, which has been very sticky over the last year. But the good news is, with every passing week, there's more and more conviction that food inflation is coming down. We've had a very strong monsoon, a good sowing season. The spatial distribution is better. Global food prices have come down. So our sense is food inflation finally is going to soften. And our own estimates are that headline CPI is tracking about 30 basis points below the RBI's forecast, both in the July to September quarter and the October to December quarter. So I think the RBI would have more conviction now that inflation is going to be settling into the low fours in the coming quarters. Now, in addition to that, I think that there are also some high frequency indicators that are slowing. So I think the risks in India, as they have around the world, have become two-sided. And when you have two-sided risks, and of course, you've got the US election risk on November 5th, you want to maintain the optionality. And therefore, I think it's perhaps appropriate to move to a neutral stance now, because you now have the option to respond to these two-sided risks. One final thing I'll say, however, is that even if the RBI does move its stance to neutral, it needs to be careful that that doesn't come across as being too dovish, because the fact is financial conditions have eased meaningfully in India. Bond yields are down 30 basis points. All right. And so it's not that financial conditions are very tight. So I think what the RBI wants to do is buy optionality. It wants to move to a neutral stance, to move in any which direction. But until it's ready to cut rates, you want to be a little bit careful in your tone, because you don't want to cause easy financial conditions to become even easier, because then that defeats the whole purpose of a neutral stance.
That's the whole point, Sonal. The financial markets, barring the recent pullback because of the escalation in the Middle East, the financial conditions can hardly be considered as tight in India. The way asset inflation has gone, do you think the Reserve Bank should actually go ahead and cut or even go neutral this early?
Latha, short answer, yes, they should. And I think, the thing with financial conditions is we have a flexible inflation targeting mandate. And these supposed easy financial conditions have unfortunately not resulted in stronger growth impulses, whether it's in terms of the discretionary consumption or actually the strength even in the broad-based private capex revival that we've all been waiting for. And it has not led to inflation pressures. So if there are pockets of excess, then you have targeted tools to deal with it. And I think, at some point in time, monetary policy needs to become forward-looking. Just as the last 2 months inflation dipped because of base, the next month or two, the pickup is also because of base effects. And inflation is not going to hit 4 and stay at 4, right? So we'll either be above or below. So you need some other indicators to gauge whether we are aligned to the target. And we've done, a bunch of analysis around that, and that suggests that, 94% of the CPI basket is currently running at 3% inflation. So if the 6% of the basket is leading to volatility but is not leading to any spillovers, if growth momentum indicators, as everyone is pointing out, is already slowing down, and there is a policy induced tightening in credit to specific sectors, and consumption indicators are soft, then there are growth risks, and we know that monetary policy works with long lags. So I do think that inflation is aligned to the target, and there are downside risks to growth, particularly relative to the RBI's projections of above 7. So the balance of risk has clearly changed, and we have to become forward-looking, and FY26 CPI is tracking 4%.
No, I'm not arguing against goods inflation, but data about softness is not one-sided. See, we saw Dabur reporting very poor FMCG sales, but Marico reported very good, high single-digit FMCG volumes. It is a little difficult to come to any steady conclusion on growth. And Samiran, therefore, let me persist with this question. Whether it is US or India, the asset inflation is not something the Reserve Bank can be blind to. Yes, because of the SEBI's announcement of FNO, there has been perhaps some pullback. But the way asset markets are moving, can a central bank cut into this kind of euphoria in stock markets?
So the challenge has been that while RBI has been continuing with this withdrawal of accommodation stance, this withdrawal of accommodation is not resulting in any tightness in the financial conditions index. In fact, by our analysis, the financial conditions have loosened rather than getting tightened. Whether you look at the liquidity side, the short-term rates, or you look at the impulses coming from the equity market or the impulses coming from the FX market, everything has been contributing to this softness in financial conditions. Now, this is somewhat difficult to draw a one-to-one correlation between financial conditions and asset inflation, but literature suggests that there could be a connection. In the Indian context. The series is not long enough to get a very nice academic econometric result out of it. But I would say that the challenge in changing a stance today is that, as Sajid was also referring to, there is a possibility that the market will run ahead of itself and the financial conditions will loosen even further. So it's a delicate balance. If the RBI changes the stance, how does it convey that the stance change is not equivalent to a rate cut? The rate cut is still quite far ahead. If it is effectively able to do it, then a stance change is possible. Otherwise, it's probably better to wait it out. RBI has waited out 19 months. Another couple of months will not make a big difference, according to us.
Fair point. Soumya, the bigger point is, what is the point of a rate cut now? The way banks are chasing deposits, there is still a crunch. So is it a moot question to even ask for a rate cut now?
No, yeah, Latha, I agree with your point. I think the deposit and the credits in the financial system begets a larger issue right now. I think what is happening is that because of this financialization of savings, because of the innovation in the financial system, because of the increasing changes in the payment infrastructure. For example, I'll just give you a simple example is that today, even as the reserve money growth has slowed down, the money supply growth continues to be in double digits, thanks to a significant increase in money multiplier because of a lower currency to deposit ratio. So these are all innovations which are happening in the financial system. What in effect it is doing is that it is putting several layers of financial intermediation. So for fund flow now in the financial system, fund is flowing for some say banks to mutual funds. The same fund, mutual fund, is now coming back to banks via the TREPS window, which is in one-day one, and where the rates are 6.50 to 6.55%. So in effect, that is actually the lower bound to which rates could go in the financial system. And banks typically will not want to lock in papers of longer duration like CDs, CPs, because ultimately they have to go for an asset liability management. So if I take all these factors into consideration, different layers of financial intermediation coming in, different payment infrastructure, innovation, digitization, I think the rates are unlikely to come down in the near future deposit rate, even if suppose the RBI starts to embark on a rate cut cycle. So my sense is that...
Soumya, I have to cut you there.
Yes.
I have to cut you there because we're running out of time and we have to take the vote. Dr. Sen, just the final point on the November American elections. Do you think the Reserve Bank, you began by saying even earlier that the Reserve Bank should be even-toned. Is there another huge uncertainty why the Reserve Bank should not sound dovish or hawkish?
No, in fact, the Reserve Bank should be very, very careful to keep all mention of the global development out of their own policy statement. This is something which we are today in a very dicey situation. We don't know which way the game will go, and it's not good for a body of the stature of the Reserve Bank to take a position overtly. What they do internally is a different matter, whether they take it into account. But that only actually just changes the degree of risk that they face. I don't think they will actually make...
No, not overtly. I meant that, ahead of such an event, is it better just to remain very, very, neutral and not sound hawkish or dovish? But that's what I meant. Anyway, thank you. We're out of time. We can't belabor this question anymore. Let me ask you all to take your electronic machines and vote. What will the Reserve Bank and the MPC do to rates? Let me start with you, Sajid.
Hold rates, they'll pause.
Hold, okay, hold. Soumya?
It's
Hold, okay. Sonal?
They should cut 25 basis point.
Here's the first cut. Samiran?
No change.
3:1, sir, in favor of hold. Dr. Chairman?
Hold.
Hold, okay. So it's 4:1 in favor of holding the policy. Change of stance. Will the MPC change its stance from the current withdrawal of accommodation? Sajid?
Change to neutral.
Oh, okay. Sonal?
Change to neutral.
Obviously, you voted for a cut. Samiran?
Hold on to the stance,
Hold.
but it's going to be a close call.
Okay. Soumya?
We'll hold on to the stance.
Okay. 2 holds, 2 change to neutral. Dr. Sen?
Change to neutral.
Change to neutral. I think your members are veering to your point of view. Now, the final question, when do you see the first rate cut? Sajid?
We're looking at December.
Okay. Sonal, I think yours is October, right?
Yes.
October. You already said that. Samiran, your first rate cut?
February or April.
Okay. Soumya?
February.
Dr. Sen?
Yeah, I would go with February or April.
Okay. So there you are, the majority expecting the first rate cut only next calendar, but there are at least 2 people dissenting and 1 expecting a cut right away. Makes it a very interesting policy. Thank you very much, members of the Citizens Monetary Policy.